everyone. Welcome to Market Talk Monday with Isaiah Porter and the team at Foundations Investment Advisors. Isaiah, thanks for being here.
Yep, have to.
You have to.
I'm just kidding.
You still have to go to work. You don't
Yep.
go to work because you want to, not because you have to.
I go because I want to.
That doesn't sound very convincing.
It is good.
You come to work because you want to?
Mm-hmm.
All right. I'm sure clients are glad to hear that.
Every day.
All right. So the week of September 26th,
Mm-hmm.
and kind of looking at a week in arrears, how'd we do?
Yeah, we did well. Markets are up. And then it's funny you asked how we do. I had actually two client reviews on Friday. And it kind of goes with what Fed Chairman Powell was talking about, the market currently being overvalued or highly valued. And I brought that up to two clients because we do have a portfolio, and I don't really like talking about our specific returns because it gives people
False sense of security of how well things are going.
Yeah, absolutely. So one of our accounts or one of our portfolios is up 30% since May 5th, actually since Jacob's birthday. It's up 33.
Cinco de Mayo.
It's up 33% year to date, 72% year to date since January 1st. But that's the conversation I had with the clients in the review is, hey, as we get closer to another Fed meeting, that we look at maybe transitioning and taking a little bit of the chips off the table. I don't have a crystal ball or anything, and I don't know. And it's not if the market corrects, it's when the market corrects.
Right.
And I don't have a crystal ball to know when it's going to correct, but we are due for one. I believe that wholeheartedly, especially if you look at the other side, like we've always been saying, the two different sides of stories. You look at what's going on in the economy versus the market, and we keep sounding like a broken record, but there's going to be a correction. I just don't know when it's going to be. And that's what even Powell noted at, or Fed Chairman Powell noted at was, hey, things are a little highly valued. The greed scale is really high. And that's what I brought up to our clients on Friday was, hey, let's take a little bit of chips off the table. Let's maybe look at some other positions we can go in with. If there is a correction or when there's a correction, you're not exposed to so much market risk.
So when we kind of pull this back and we look at it from the concept of a 40,000-foot view using the kind of the airplane pilot scenario here, when we've got a bigger scope, bigger glide slope.
Mm-hmm.
The 100-year average on equities has been over 11% mathematically. So when you take 100 years, divide market returns over that period of time, both positive and negative.
Yep.
We've been a little over 11.1.
Yeah. And to go back before you continue, to go back and correct what I said, the markets are up today. I want to say this is ending on Friday. So actually the markets were, the only thing is the S&P hit a 28th record high, but finished down 0.3%, and everything else did finish and close down on Friday for that week. But right now they've rebounded a little bit.
And as of recording right now, it's a little mixed, right?
Mm-hmm. Yeah, you'll see the Dow's probably down right now. The last time I checked, it was down. S&P was up, and the NASDAQ were up.
Yeah.
There's those tech stocks again.
Yeah. Well, the point that I wanted to make, Isaiah, is that no one has 100 years to really experience market returns. Not unless you're a fund or some index that has unlimited time and unlimited resources.
Unless you're an inanimate object.
Right. So the markets are going to do what the markets are going to do. It's that time span of when we're in it.
Mm-hmm.
And most human beings who are in this market,
Mm-hmm.
and let's just focus on U.S. citizens, when you're an investor, you might have 30 to 40 years to really experience what that 100-year average is going to mean for you.
Mm-hmm.
And any time that you start compressing those returns over periods of time, you have a higher probability of wacky things going on. We always talk about the lost decade from 2000 to 2009. The stock market in that 10-year period finished negative. 1929 to 1939, the market finished negative by about 4.5%, compounded losses over that period of time. In the first 4 years of 1929 to 33, the market gave back 75% plus of its return from the early 20s.
Yeah. Yeah, it's if you look at, I think about it like options trading. If you look at it, and for all my options traders out there, if you look at it and you shorten the duration of the option, the bigger the volatility swing.
The more the risk.
So it's the same thing in retirement planning. The shorter time span that you have, the more volatility you can see. Even in our tools that we use in software and analytical tools that I have that I can use, if you look at if you have an annualized target return of 4%, you could see in 6-month time periods, you could see volatility of a 14% upside to a 13% downside or 7% downside. So yeah, the shorter duration you have, the higher probability it is or it is going to have higher volatility swings.
Yeah. So Darren Levitt, who's a CFA at Foundations, he writes the overall commentary for the folks at Foundations and investors within the firm. So the sentiment for the week of the 26th and looking forward this week, the 29th forward, what are you thinking? What should consumers be thinking about in the short term?
More volatility. You're going to see volatility on the upsides and down. So I think this is what I told the clients this past week, and their situations are different than everybody else's, but I think you can kind of take a sentiment of we look at what I told them is, hey, let's hold kind of still. Again, this is what I said last week as well, and the week before that is let's hold kind of still until the next Fed talk. See what happens, how people respond to cut rates. But I think we start looking at taking some chips off the table as we get closer to 2026. It's the same thing we told our client base coming into 25, that, hey, let's start looking at taking some chips off the table and then start going back in as we see fit. And then, I mean, if you look at 2025 for the year, we kind of said that at the beginning. We had April with kind of the trepidation from the tariff spike. And then after that, I mean, relatively speaking, it's been smooth sailing since then.
Yeah.
But I think as the geopolitical environment starts to heat up a little bit more of what's going on with Trump and Netanyahu talking about, he's always promising that there's some big breakthrough that the Middle East is going to have, versus now instead of saying he was going to end Ukraine and Russia in 24 hours, he's now saying that, if Russian planes fly over NATO airspace or insert themselves in NATO airspace, that NATO can shoot them down. So there is a bit of a geopolitical heat up, and if that plays on the market, it does. But I think it's like I've said before, it's hard. We're in a time now where I think it's harder than ever to kind of predict what media is going to do to the overall market sentiment, just because, and I've said this to clients as well, if you take this AI space and this tech space, back then when tech first came and like computers first came, it was more of like if you have this tariff on an import, it's going to affect the supply chain, and this is going to make this go up, and it's going to make this price go up, and this is what's affecting the overall valuation of this company and that stock. Now you look at AI and how it's being used and how these tech companies are being used, not only for consumption for consumers, but also for governments and warfighting.
Mm-hmm.
So when you have a geopolitical environment that's heating up, people usually run to defense sectors because you see Lockheed Martin's building new missiles or whatever they're doing. They're preparing like a war machine if you see a geopolitical environment heat up. But now it's kind of blended, and it's hard to really see like, okay, there could be an Intel chip or a GPU or something inside of these drones that's making it go, that's from these NVIDIAs or from these Intels or from whoever the company is that's providing these. You see it's kind of intertwined now where the tech sector and defense sector are kind of merging a little bit, and it's hard to really tell, like, okay, well, if we have these tariffs over here that are implying big prices on, like, I'll bring it all the way down, like a PS5. PS5's prices went from their newest PlayStation model, the PS5 Pro, went from like a $600 gaming system to now it's like $750 because of the tariffs that were implied on where the products were coming from.
Speaking of, on that front, there was some big news with Electronic Arts.
Yep, private. Going private.
Yeah, they went private to include a large investment from Jared Kushner, son-in-law of Donald Trump, married to Ivanka Trump. So that'll be something to kind of keep an eye on as companies go from publicly traded to privately owned. And, you know, how many companies start to do that long-term is interesting to me, and interesting in terms of the overall broad scope of markets and why companies do that, and what's the underlying reasons behind not wanting to keep a company public. You know, is that a play to shore up a balance sheet, put more money on the table, and then make a play for other future companies? It's going to be interesting to see that play out.
Yeah, it gives the company, I think, a little bit more control of what goes on with. I mean, of course, they're privately held now. Now, the company and its board of directors has more control on the direction of the company without having to take the public or the consumers. Basically, the consumers like, oh, I want a piece of this. I want to be involved in this. Now they get the full direction of where they want to go.
Yeah.
And when they start getting maybe some investments from some private contributions from bigger parties, that they kind of get to do as they please with these contributions.
Yeah, right. Without the scrutiny of
the public,
governmental oversight, and a bunch of shareholders. Yeah. Switching gears kind of to more of a more macro economic look, I found a couple of charts interesting just perusing through Instagram this morning that I think is relevant to your market commentary and what's going on in the stock markets. Is let's look at interest rates. And guys, if you can bring up the interest rates around the world, I thought this was really interesting because I hear folks complain about our interest rates all the time in the U.S. and how expensive it is. But I think if we look here, Isaiah, interest rates around the world, this is provided by Invest Billionaire. You can follow them on Instagram at invest.billionaire for more really good infographics. When you look at the top 5 kind of cheapest countries out there, top 6, Singapore, Euro, Canada, China, Australia, and the U.S. Singapore being the lowest country's interest rate at 2.3 or 6.3%. The U.S. falling right there at 4.5%. But to other developed nations in comparison, Brazil, who's interestingly enough part of the BRIC, Brazil, Russia, India, China. When you start looking at those countries, you've got Brazil at 13.3%, Russia's interest rate at 21%, Argentina at 29%. And when you start looking at India, even at 6.5%, compared to right here, good old U.S. of A., compared to the rest of the world, we're relatively inexpensive in terms of our cost of money, which is our cost to borrow, cost to debt. Not bad.
Yeah, it is. And you can, like I said before, you can kind of see the impacts of what a war does to a nation. Granted, Russia has sanctions and heavily sanctioned from the United States. But
European Union.
You can kind of see that what it's telling to its citizens is, hey, we're kind of taking the funds that we're getting in and we're applying it to be able to fight the war we're fighting. And borrowing money right now is very expensive.
Yeah, who wants to borrow the ruble?
Yeah.
Nobody at 21%. I mean, there's countries with worse rates. I was trying to remember the African nation that they have issued $1 trillion treasury.
Was it
Zimbabwe? Which basically just makes their currency worthless. But when you take U.S. interest rates and compare that to the U.S. debt, in contrast to other developed nations. Can you pull that chart up? So here's the U.S. government debt versus the world. Now, when we say the world, we included India, who's got arguably what, 2 billion
Yeah, it's like a
people?
billion people.
China at almost 2 billion people, and then Japan and the UK. Those 4 countries, those 5 countries, 4 countries.
India's debt's basically our interest that we have to pay.
Yeah. So when you think about that, the interest payment on our debt compared to their nation's debt, and the size of us compared to the size of India. Guys, bring up the U.S. debt clock if you can. And let's look at this. So when this factoid or infographic came out, the U.S. debt was at 35 trillion. The U.S. debt clock right now is a rolling
37.
clock, is at 37 trillion and some change. That's an interesting look at what we see happening in our country. And what I want to break it down to is what's the debt per citizen, and then the debt per household. So when we look at it, 37.5 trillion is our national deficit. The debt per citizen, there's about 370 million citizens in the U.S. That's a $109,000 credit card bill for every citizen.
Yep.
For taxpayers, it jumps to 324,000.
Yeah, because per citizen could be Chapel.
Yeah, right.
He's a citizen.
Exactly
pays
right.
one,
But if you look down at that middle left, top left column where it says U.S. federal spending official, if you guys can show that, you're there, just right under the national debt. Just put your cursor.
where it says
7.4 trillion. Up.
Right
up.
above the Doge clock.
There you go. U.S. federal spending, 7.4 trillion. And then I want to go over to the U.S. federal tax revenue. This is why we have a deficit.
Yep, we're 2 trillion, spending over 2 trillion what we pulled in.
Yeah. So when we're going into debt faster than we're taking revenue in, that's what's causing that deficit to raise. And, there are some economists who say as long as GDP can grow at 3.5%, there is a probability that that debt could go into perpetuity. Now, when I think about this long term, I don't know that I necessarily agree with that. So I think a lot of folks are of the mindset that at some point this is going to turn into a debt bubble that's going to pop. And we're going to have to see one or two things happen. Mandatory spending and mandatory expenses, they're going to have to give. So if mandatory spending is not cut by at least half, we're going to be in trouble by 2034.
What's super interesting to me is if you look at the U.S. money supply now, so dollars in circulation compared to our debt, we're at 22 trillion, 203 million, 196 million, 200-some thousand dollars of paper dollars in circulation versus, so we don't even have enough paper dollars in circulation to be able to cover national debt. It's kind of interesting.
It starts getting a little mind-boggling.
And then you go look at currency and credit derivatives. That's at 723 trillion, 812 billion, 594 million.
Yeah. And the derivatives is kind of the compounding on fiat currency.
Yep.
That's what we're talking about there. But the one ratio that's really, really scary is the U.S. federal debt to GDP ratio.
Yep.
So now it's at 123% debt to GDP. So we're 123% over what we should be. In the year 2000, that ratio was 56%.
So almost half.
Debt to GDP. Or think about that, debt to income. In the 80s, it was 34%. The 1960s, it jumped again, and we was at 52%. But we're 123% of what we have in income is going out in expenses. So if you think about that from a credit card point of view, your debt to income ratio is at 123%. nobody should be able to let you buy anything. If you went to your mortgage broker and said, hey, I'd like to buy a house, and they'd go, okay, well, let's look at your debt to income
DTI.
ratio,
They're
your
at a hun-
DTI.
You get 123%. They probably wouldn't even
Most lenders don't want to give you any money, Isaiah, unless you're under 43%. Right? Cody was in the mortgage business at 43 now.
Yeah, it's about 50, but right
Okay.
around there.
Yeah,
They wouldn't even give you $1.
yeah. They're going to want you to write them a check.
Mm-hmm.
So, folks, when we look at this from a macroeconomic point of view and you bring it back to home to you, when we give these market commentaries, and Isaiah's talking about this for clients who are invested through Foundation's Investment Advisory, the key factor here, the key takeaway, is diversification. You can't have all your eggs in one basket. That's, if I'm going to just simplify it, that's the message we're going to preach all the time. Reduce your risk, diversify, and find out a way to make cash flows king in your house.
Mm-hmm.
We've said this many, many times, especially with clients we talk to. Interest rates don't matter too much.
Mm-hmm.
Cash flows matter the most.
Yep.
So if you've got positive cash flow, or another way we've said it, income should be the outcome. No matter what phase you're in, you have to have more income than you have outflows. So income is the outcome. That's what we want to try to achieve here. Hope you go make it a great week. Any parting thoughts?
I'm good to go.
Again, smash the like button, subscribe, and give us some feedback. Give us some commentary on what you're thinking. Anything you'd like us to talk about on Market Commentary Mondays, we'd be happy to put it out there. Thanks for sticking with us. Love you guys.
See you guys.